So, Joel, thanks for the setup from a macro perspective. Now we're going to dive a little deeper, really going a little bit more granular into restaurants in particular, with hopefully some discussion along the way. Then we'll try to distill it down into some key takeaways for you and frame the implications really for 2016 for the restaurant industry. So we're going to kick it off with Bob, going through a couple slides here.
Terrific. Thank you very much. Appreciate it. And thanks for chairing the. We really appreciate having you here. This is the time of year when we get a lot of questions from members about what our expectations are with respect to the coming months, the coming year, what we saw in 2015 that can be applied. Even when the markets, and Joel talked about this, even when they're relatively calm, making these forecasts is tough. And there are those among you, I know out there, who could consider this an inexact science. And we've heard the jokes before about the fact that the only reason we do forecasts is to make astrology appear legitimate. But there's really more to it than that, I promise you. Nonetheless, our fearless TDn2K team is undaunted by recent events, correct? And we're going to press on and give you our impressions of what we've seen in 2015 and what we can look at in 2016. Now, as Joel talked about, I'm sure many of you in the audience have had second and perhaps even third thoughts about what's been going on recently with the equity markets and in the economy. We're going to take our crystal ball and try to apply some of the things that Joel said to the restaurant industry in particular, and we'll talk about sales, we'll talk about traffic, we'll talk about staffing and turnover, turn our eye towards social, and talk about what we've learned and maybe what the implications are for 2016. That's okay. So the red line is a graph of 3-year comp sales from 2013 to 2015. Now, when we sat here last year with this group, we were pretty optimistic. If you can recall, if you were in the room, Joel had just painted a great picture about what the economy looked like. We'd had a terrific Q3 and Q4, and we really had a lot of tailwind. We thought this was going to be a spectacular year. And our thoughts were validated after Q1. Q1 was the strongest quarter in BBI history. We were up 2.9%. We'd never had experience like that before, so it was really terrific. Now, you can tell by the graph that every quarter after that went down a little bit. Part of it was because we were comparing tougher comps from the prior year. Some of it might have been due to the weather, but nonetheless, we ended the year relatively weak at 0.4%. And there are some folks in here that kind of think, hey, we limped across the finish line, and that's not a really good thing to do when the race starts again the next day. But I'm going to challenge the group and say, hey, was this glass half empty or glass half full? Because for the year, we were up 1.6% in comp sales, which is, again, the strongest year that BBI has ever had. And the strength was not necessarily across all segments. There were some that were better and some that were worse than others, and we'll talk about that in a little bit. 2% comp sales growth over 2 years. So it reinforces what Wally's talked about. It's reinforced what we've talked about in the past, that this is a market share battle. And over 2 years, we've had 2% growth, which is pretty good compared, but maybe not the robust growth that a really growing and thriving industry has seen as in the past.
So wait, before we go on.
Yeah.
So Joel, how does a trend like that square with your next year's, kind of forecast of a bit more robust outcome for 2016? It seems like, the last data point in particular is not great. So what happened in Q4, and why will it turn around again in Q1, 2, 3?
Well, I think the key is the issue of confidence. And some issues were arising in the fourth quarter that actually caused consumer confidence to come down. If you take a look at some of the October and really November numbers in confidence, there was a little bit of a shaking of the confidence. It wasn't as if the economy was weakening, but some uncertainty was coming into households and their thinking. I suspect that may have been part of it. The other thing, and I know Bob's talked about this a lot, is the idea that when you've done really well at the end of one year, you set up a high comp that you have to take out the next year. And that's what we really did in 14, is grow pretty strongly at the end there. So we needed even stronger growth off of a higher base. I think what we have to recognize is that consumer tastes have been ebbing and flowing. There were some issues that were out there. But when it comes down to the consumer in 2016, I'm heartened by the fact that the December confidence numbers were coming up, the early January confidence numbers were coming up, and maybe most importantly with the gasoline prices, for a large part of 15, consumers were used to seeing gasoline prices decline, and they saw them go right back up. They've seen them down now for almost a year. They're now beginning to believe it might be real, so they're starting to change their consuming patterns. And I think that may help, as well as the stronger economy.
Okay.
Let's turn our attention to a fundamental issue that we've talked about quite a bit in the past. And this is a continuation of a trend that you have heard us talk about in the past. The blue line is guest counts. It's traffic, as reported through the BBI system. And you can tell that they are continuing to be negative. We almost made it positive in the fourth quarter of 2014, but didn't quite make it over the top. So our inability to get consistent top-line traffic sales is certainly a result of not having enough people come through the doors. And we'll talk more about that throughout the conference. The difference between the red and the blue lines is what we call check average. So it's a combination of pricing and mix. And that gap, as you can tell, has been growing. So it was maybe 1.8% in 2013, got a little bit larger in 2014. The gap really grew in 2015 to where it's over about 3% for the year. And that implies that we're getting more dollars from every individual that comes in. Now, some of it's pricing, some of it's mix. There were, I think, 21 or 22 states in 2015 that raised their minimum wage. And we took a look at the check average in those states, and it did not go up any more than the states that did not raise the minimum wage. So I don't think that this pricing or this check average is necessarily driven by minimum wage increases or labor increases. It's probably driven by opportunistic pricing, perhaps some commodity response, as well as perhaps more targeted and efficient marketing on that behalf of your marketing departments who are getting more value and having promotions that are more appealing and targeted to your target consumers. Now, this is all top line. There are different ways that we can cut the segments, and we're going to talk a little bit about that in the next few slides. We look at 6 different segments in the black box realm. Casual dining, as you can tell, over the last couple of years has trailed the industry in consistent years. Fast casual, QSR, and fine dining have outperformed. Upscale has been performing better relative to the industry, and we continue to look at this and continue to refine it because we have not only the traffic, but as well as some of the social pieces that tie into this as well. There are other ways that we cut the analysis of sales, and Victor's going to take us through a little bit about the geographic impacts and some of the things that we've seen there.
So as Bob was saying, that's kind of the top line, but of course there's some differences once you start drilling into the data, and that's one of the things we encourage you to do is look at that regional, state, market level insight, which is where the market share battle is really being fought. And one of the things we notice is that great correlation that exists between, in this case, personal growth in income, so the overall income of the economy, and our comp sales. So what this map is showing, anything that shows the darker the green, the better the ranking of that state. So the darkest green in the left would be the one that has the best comp sales for our group in Q3. The darker the red, the worse the comp sales in ranking perspective. So that'd be the last state would be the one in the darkest red. And on the right side, you see the same analogy, but looking at personal income growth over the year, Q3 over Q3. We did it in Q2 and the same relationship held. And then that's where you start seeing some of those examples, those explanations of what is happening. For example, you see California. It's been top performing segment for us, or not segment, but region. We call it a region in our data because it's that big. But as a state, it's doing really, really well. You can see it in dark green. They're doing really well in their comp sales. Guess what? They're really doing well in their year-over-year personal income growth. And one of the things to recognize here is that it's not as much the income where it is right now, but that change year over year. If more people have jobs, if income is growing for those that are working, they have more money today than they had a year ago. When they go out to eat, that's going to impact their comp sales patterns. The other thing that you can notice here is, and we've been hearing a lot about this, is the whole effect of the energy sector, what's happening with the oil companies. And you can see, look at the ones in red. You see North Dakota, you see the Southwest, which has been our worst performing region in the country because a lot of those states are affected by that. You see Oklahoma, you see New Mexico, you see Louisiana in the red in both of those cases. Texas, which typically has been a very, very strong state and region for restaurant sales, you can see how now it's slowing down, and a big part of that is the big reliance in a lot of regions and a lot of DMAs specifically on that. Now, is that saying that every single state follows the pattern? Of course not. There's some discrepancies there, as you can see in the map, and that's where there's other dynamics. It can't be as simple as just income and sales and traffic relationship. But you can really start seeing why some of those relationships are there and what makes sense from that perspective. So shifting into labor market, and I know Joel's been talking about that this afternoon a lot, and here we're seeing our numbers as measured by People Report in those colored lines, and you can see the drop, of course, recession then, but it's been a steady increase since then, and you can see the dotted line showing unemployment rate. A couple of things to notice about this is, first of all, this is hourly turnover, and you can see for quick service, for fast casual family dining, we're still not at the levels we saw in 2007. And unemployment has not reached the bottom of that graph. So there's still tightening of the labor market that will happen, and we're probably going to have to suffer through when it comes to those hourly employees. And then the other factor is you can see for upscale in casual dining, maybe kind of the same level, but the fact that unemployment is going to hit everyone means that they're probably going to reach higher levels than what they saw before the recession. So it's really becoming an issue, really becoming a challenge for the industry right now, especially in this new environment with comp sales that are not as high as they used to be. We're looking at 1 to 2%, and then on top of that, you have the problem of labor costs and turnover costs going up as well.
So Victor, just maybe to play off this chart a little bit more, last year we sat here and said we thought the labor market was going to tighten. We thought it was going to tighten significantly. It was my recollection. And while it appears that unemployment's down, turnover is up, it doesn't seem to be coming through on the wage side. So what's the explanation for that? Why is there not as much wage growth as we might anticipate?
Right, that's a great question. We had
Is that the next slide? I'm sorry if I jumped in.
We can, that's the idea behind
Two
this.
slides, I'm sorry.
Yeah, so...
It's like we rehearsed it.
So, and I know there's a lot of numbers there. I just wanted you to have the slides. We're going to make the slides available for you, for you to have this extra analysis. So the blue in the middle shows the increase in wages at the top and salaries at the bottom for a couple of positions and segments as an example. And like you were saying, there's not a lot of growth there. A couple of things I think are happening here. One of them is the underlying phenomenon in unemployment is, what about underemployed people? What about different age groups, teenagers still having much higher unemployment rates than the rest of the groups, and that's who we hire typically in a lot of cases, especially at the hourly level. And then the other thing we see at the management level is that turnover is so high right now, and we can go back to that one here. Turnover is so high for managers. It's higher already than it was in 2007. So that's an interesting phenomenon. We're seeing the pressure really hit managers right now. And what seems to be happening is you're replacing as an industry that manager that was there for a couple of years and their salary was probably a little higher with someone who's being promoted from within and probably coming in a little lower. So on average, we're seeing actually wages going down in some markets and not going up as much as we thought they would in some other markets.
Yeah, I think what you're really saying is we're changing the composition of the workforce in the respect that we are paying for our turnover by bringing in newer, less skilled, less productive workers. And you may have a lower average, but that's because we're replacing some of the more skilled, more experienced workers who are at a higher level, who are either being promoted up or actually leaving or switching jobs. And it's an interesting mathematical thing. We can have a situation where even in our companies that the new people we're hiring are coming in at a slightly higher entry-level wage, but because they're replacing somebody who had a higher wage to begin with, our total average is going down. And the averages can indeed, mislead a little. They can hide some of the dynamics. And I think what's happening in some of these data, and the turnover is really the key here, it's not just management and everywhere else, is that we are in essence, paying for our turnover in the productivity side because we're bringing in these lower paid but also lower skilled people.
And that brings an excellent point of the fact that we're at so high levels of turnover for managers, and we found the correlation between management turnover and hourly turnover. So if your managers are leaving sooner and leaving more often, your hourlies are probably going to be affected by that, and regardless of what happens to the market, you're going to have that problem, and it's going to translate into that turnover. But then on the other hand, and we've all talked about this, is what does it impact on the sales side, on the guest satisfaction side? And what we're really excited about right now is that the fact that we have the social data through Whitebox means we can actually hear a little bit about that. So what do we know to be true, Kathleen, in terms of turnover and guest satisfaction?
Yeah, so the interesting thing that we're finding more and more is that turnover is not only impacting your bottom line and your employee, but we can prove that it's impacting how your guest experiences your brand and each unit that they go to. And there are differences between a unit that has high turnover and a unit that has low turnover. Our White Box members just saw in their quarterly report really incredible correlations with Yelp data of all things, right? Where guests online are giving better review scores to units who have lower turnover. That's management turnover, that's hourly turnover. And a number of companies we've worked with, we've seen higher scores in terms of great service, great food, all correlating with lower turnover. So it's something where the guest certainly doesn't know that the turnover is high or low in the particular unit, but they're seeing the results of it, and then they're sharing that with their friends online.
So last year, again, when we talked, the correlation between comp store sales and low turnover was best between managers and stores. Is that remain the case, or is it flipped over and now there's a better correlation with hourly employees, or do you recall?
It's still managers, the one that drives the most. And part of it is just the really high turnover you have in the hourly world, where it's difficult to make much of an impact there. But we do see is manager correlating to comp sales, and then manager correlating to hourly turnover as well. So there seems to be that relationship that carries over to hourly in that regard.
Okay.
Yeah, and there's one final point I want to make, at least as far as keeping the wages down aspect, and I know it's something you talk about a lot also, and it's this idea of is there a low participation rate? Is there some sort of reserve or frustrated worker out there? And if you take a look at the labor force participation rates, for example, for teenagers, they're the lowest out there, there's no question, other than people who are over 75. What can you do?
There you go.
But more importantly, in the last decade, that participation rate has fallen by 10 percentage points. I mean, they are just abandoning the workforce. But the one good thing, and maybe the bright light in all of this is that first of all, that they're out there and they are potential workers. And the second thing, if you look at the more recent data, we're actually starting to see the participation rate of the 16 to 19-year-olds go up, which means that as the turnover rate has gotten to the point where businesses are really starting looking for workers, they're drawing those workers back into the workforce. I don't know whether that's a wage issue or that people just see that they can get a job now. But this is, I think, mitigating to some extent, at least on the hourly side, some of the wage pressures that may be out there.
I think this is kind of the new frontier, because there's going to be a common theme throughout many of the sessions that you hear while you're in Dallas about this whole labor part. And we talked about comp sales before, but this issue of the true cost of the churn, of not only tying turnover to training costs and recruiting costs, but the whole productivity issue. I think we have a lot more work to do as an industry to really get into the bottom of that, and I think there's going to be a lot more commentary as we go through the next couple days.
Okay.
So one of the things we saw at the end of the year, and you know, I alluded to it a little bit when we're looking at the map, is that slowdown that happened near the end of the year, and the graph that Bob showed kind of shows that. So one of the things we asked ourselves is, what was there that made a difference, and what made an impact in brands that did better than others when it came to that slowdown? And we have some really interesting data on the social.
Yeah, so we know there are many dimensions to what happened in Q4, right? And we addressed some of those at the start, but one of the things that we tried to understand was, did everyone have a bad Q4? Or were there brands who actually had a great Q4? And what we did was we took our top brands and our bottom brands and said, what were the differences between them? And when we say top performing brands, we're talking about brands who had on average over 5% in terms of comp sales. And we saw that online, when guests were talking about experiences at those brands in Q4, their overall satisfaction was going up in terms of food, in terms of intent on return, as well as other dimensions that we track. And we think that there's something to be said about that maybe it wasn't truly that everyone had a bad Q4, and that brands can take a little bit of a deeper look at exactly what their guest is telling them and learn a little bit more about why their Q4 was so good or so not great, rather than simply looking at the macro trend.
It's interesting that the guests are telling us, they're telling restaurants, the same things that your multi-units and your general managers are seeing on a day-to-day basis. They go into the restaurants, they've got checklists, they look at things, but the guest is saying the same thing. And it's great to have that consistent message.
Exactly. Okay, moving on to 2016. Well, there's a big one, minimum wage. All right, so what about minimum wage? How much do you think minimum wage will impact this turnover that we were just talking about? Will higher minimum wages actually get us anywhere in terms of minimum wage as an industry?
You want to start, Victor?
First of all, and when you see this map, it kind of shows where we are, at least for 2016, that it's not as widespread as you would think. You know, there's a lot of talk about it. There's a lot of, it depends on where you're operating, of course. But if you look at that map, southeast, southwest, northwest, there's not a lot of movement there. Yeah, there's a lot of maybe increases that have happened, or wages because of legislation already higher in some of those states in the Northwest. But when it comes to the increases for minimum wage, they're really not as widespread as we would think, given the talk around it. Now, having said that, for those states in which it happens, of course, there's a huge impact. Part of it is we've been saying how the labor market has been tightening up, and we're expecting that increase in wages, but it's not happened. And one of the reasons I believe it's not happening as much is because a lot of those states knowing it's coming, so there's like that wait and see kind of perspective. Is I'm not going to raise my wages now because I know I'm going to have to raise them in a year or 6 months or whatever. So there's a lot of that speculation of let's wait until that happens, till we start seeing some of that movement.
So what proportion of the black box sales do you think is coming through, these green states here? I mean, California is its own region, so to speak, right? So that's a big chunk right there. New York, second biggest, most populous state in the union, right? So probably another pretty big chunk out of that. What do you think the average is there? So if you're a national chain, what are you looking at in terms of the percentage of your sales that's going to be influenced by some increase in minimum wage?
Yeah.
You think it's 20%?
I don't think
Between the
so.
two? 15? Probably something like that. Anyway, I was just curious. Anyway,
Steve?
Go ahead.
And we're focusing very heavily on legislative changes in minimum wage here. But, with the labor markets tightening, it's really a market-driven issue, even more than a legislative issue.
So do you think this is going to create a bunch of distortion above and beyond what the market forces are?
I don't think I actually think if you take a look at some of these numbers here, I mean, some of these states have increased their minimum wage by 5 cents. I mean, we're not talking about necessarily huge wages. What I'm talking about is the decisions being made by large corporations that have set up a standard for minimum wage for workers who they may not be in restaurants, but if they're in, let's say, retail, then you have a potential worker saying to themselves, should I work in the front of the house or even the back of the house, whatever it may be, working at 7.25 when I can work as a stock person in a retail store for $9? Well, that's a no-brainer. And what it does is, while it may not be regulatory in nature that entry-level wages are rising, the pressures on businesses that don't pay a competitive wage, which is becoming well above the market wage, is really, I think, what's driving it. A year ago, I didn't say it here, but a year ago what I was saying is that the whole drive for legislative increases in minimum wage may be, I won't say thwarted, but slowed by the fact that so many businesses will be already paying more than minimum wage. So it gives the legislators an out. They're saying, why should we necessarily raise it when it's not an operative wage? So but the threat to the restaurant industry is that if you're not paying it, or you're paying a sub-minimum wage, through the restaurant rules, then you're competing potentially against non-restaurant companies that are paying as much as twice as much on a fixed amount. And that raises the question about how do we structure the compensation for hourly workers.
Well, I think there's one other issue that relates to this, and that's, what about the tipped wage and how does that all work? And you've seen a number of restaurateurs come out lately, they're going to go to a no tipping policy and all the rest of that. As we go through time, from my perspective, first of all, the two states that matter here in terms of minimum wage are California and New York from my company. And the only thing that matters there is the tipped wage, because we don't pay anybody even at the minimum wage in the back of the house or some of the other folks who are non-tipped. So for us, it's all about the tipped wage. And as the tipped wage marches up, kind of how do you counteract that? How much price can you take against that, et cetera? So what do you think, is the end game here if we end up with a $15 minimum wage in some of these states where there is no tipped wage or a minimal tip credit?
I think at $15 an hour, and we talked a little bit about this before, you've got a pretty tough time making the menu prices work, and you've got a pretty tough time figuring out how tips work in that system. So I think there seems to be some sort of convergence on this issue of, if you do a $15 wage, are you really going to be in the same environment you are with tips as you are today? And does that kind of back us into a no tipping policy as an unintended consequence, rather than having it legislated, for example, or part of an industry standard, but it just may be a natural reaction to some of the mechanics that are coming on in the marketplace, where tips are just not possible at that kind of wage rate, or not in the current state. You have to redefine and reallocate how that dollar comes in.
So are people, just for the panel, would people rather have it all come in their paycheck in a wage, or would they rather continue to have this sort of lottery style of how much I earn every week, depending on what tables I get, et cetera, et cetera?
Well, my view is that most of the workers would probably rather have a secure wage than the lumpy, volatile wages that they have. And that's probably true, especially in areas that see some seasonal movements. But even across the board, if you're asking a person, will I accept $30,000 a year stable, or the chances of 25 versus 35, I think most people would prefer to do that, because it provides them security, and it gives them some means to actually sell that. I mean, we had talked about the idea that, if you make $8 in 1 month, it's hard to get a car loan when you're making $8 a month, but the next month you may make, $2,000. These are really, tough things. The stability, I think, would help, and that may actually wind up helping the industry.
It's going to be tough to find one answer that works for everyone. I think there's plenty of folks out there who think there are all-star servers out there that love the tip system because they work in places with high ticket averages and they can bring home a bunch. And when you go to a fixed wage, those people are going to become disenchanted. I think that's a natural evolution, and it's going to affect different segments and different chains differently. But I think it's incumbent on all of us in this room to think about what the implications of that are, because you don't want to drive off the superstars, and you don't want to have just, quote, average folks out there, however you might measure that. But some of those folks are really incented and are quite well compensated, bartenders. It's not just servers, it runs up and down the gamut. So it's going to be a tough thing for each of us to take a look at individually about how it affects our businesses.
Yeah, I mean, this is, I think the point you're making, Steve, is that we may be approaching one of those key cut points in the industry's history where we have to actually rethink our employment model. The industry is totally different than almost any other industry that's out there. The food service and hospitality industry, to the extent that it depends so heavily on the tipping structure, separates itself out from almost every other industry. And given this drive for the minimum wage and the change in the psychology that's out there, you're right. It may be that for some segments of the market, it makes sense to really vastly and totally change the employment structure. And it may work for both. It's not going to work for everybody, but it may work for both employee and employer under those circumstances if they can factor the added hourly cost into the prices. And then, of course, we have to educate our consumers that that's okay. You don't have to tip.
Right. Well, I would argue that there are many, many businesses that have excellent customer service that don't have tips, right? I mean, if you've been checked into the hotel today, had great service from somebody, gone to get your car serviced, had great service from somebody. So it isn't inherent that you have to have tipping in order to have great service. But I think culturally, instead of having a bunch of front of the house folks who are independent contractors at 15% of everything they sell or more, you're going to end up with a kind of different scenario in terms of how to coach, how to train, all the rest of that. And my personal view is if the minimum wage keeps marching, this is where we're headed. It is a natural outcome, and it's almost like the unintended consequence, but I'm not sure there's anything that the full service restaurant business is going to be able to do about it at some point, because consumers are just not going to continue to pay more and more and more price in order to offset this particular cost.
So talking about 2016 again, and now looking at our data and correlated to some macro numbers here, like I was saying before, what we found in terms of income, it's that year-over-year growth that really, really matters and really drives what happens with comp sales and traffic. And you can see here in the blue line, which is the year-over-year personal income growth, how it went up by so much, starting with the end of 2013 all through 2014. Then it's dropped a little bit, so that's an interesting distinction. So the growth is still high, but it dropped a little bit and it kind of stabilized. And it's that perception of it's not growing as fast as it was before. That's enough for comp sales to slow down in our industry. So I guess the question there becomes, can we keep on growing at that pace in terms of personal income for us to keep driving comp sales the way we were in the past? Can we turn that red line around? Joel, any?
Yeah, I think one of the key things is that if you believe, my forecast, and I expect that you all do because I'm always completely correct.
100% endorsement, by the way.
Thank you, I appreciate that. We're talking about, disposable income, but it's from personal income, but it's from all sources. Where I think we're going to have a change in this pattern in 2016 is the wage and salary component of personal income. And if I'm right, and if these shortages do drive up the hourly wages in the pattern we've seen, as I said, we went from 0.5% to 1.5% to 2.5%. I wouldn't be surprised it's 3 to 3.5%. If you add that on top of that solid growth in jobs, which also creates more wage and salary income, that's really the key, I think, for the restaurant business, is to get those wage and salary income growth up. And it's slowly coming up, and I expect that that's where the acceleration will be in 16. And if that's the case, we can still get those numbers to rise.
So last year, we could not correlate gas at all with, kind of what was going on from a comp store sales standpoint with Black Box. You would think that personal income growth and gas would be connected in some way into some measure of disposable income. What's going on with those? How are they interacting?
It's really interesting when you look at those lines here. The red would be comp sales, the blue the year-over-year change in gas prices. Again, it's that year-over-year which correlates the most. And what's interesting is you see that big jump in the red line when blue line dropped a lot. So the initial big change. So basically month to month. So let's say I'm paying $2 versus I'm now paying $1.80 or I pay $2.20. That's not enough to really drive that big of a difference. But if I was paying $3 before a year ago, now I'm paying $3 or $2. That dollar does make a difference. But it seems that it was that initial change. But once you're at the new level, it pretty much became independent in a way. It's almost like, okay, that's the new price I pay, and I don't feel like that difference in the price is really driving much of the behavior. And what was also very interesting when you look at that data is that there's some correlation to the comp sales. And we saw this a year ago, but it's also here now. Comp sales, there's a little correlation, but when it comes to traffic, there's virtually none. So what all of that's saying is the fact you're paying a lot less in gas will probably make you order that extra beverage or the pricier entree once you're at the restaurant, but it's really not driving people to go out more. It's not, and when you think about it, a family of 4 or 5, what you save in that one trip to the gas station is not going to be enough for you to take everyone out for another meal. So it's probably just that extra spending once you're there. So what this is saying is that kind of the effect of the gas price is already kind of behind us, and it's a little behind us at this point, what we can drive extra in terms of that gains from the gas.
There may be something that's confounding a lot of this data in 2015, in terms of gasoline prices and even income growth. It's the simple fact that we had the largest sales of motor vehicles in history. And that's a real indication of consumer confidence. But what people forget is that very few people write a check for their motor vehicle. They do write a check, but it comes from their financial institution. And they give it to their, the dealer, whoever they're buying it, whether it's a new car or a used car.
They sign and drive is what
They sign and drive, right. And then the next month they get the bill from the finance company. And if you think about it, a lot of what households did in 2015 is take a lot of the extra income they got and put it into things such as vehicle loans. And that really took a little bit out of purchases from other retail kinds of sales. So if you look at it, going forward, I think we've probably peaked in vehicle sales, and they may actually start falling a little bit as we go forward because we set such a record high.
What was that number this year? Was it 18?
Well, we actually broke on a monthly basis for several months over 18 million. It's about
Annualized.
Annualized, it's about 17.5 million for the year, which there was only 1 year that came just about at the same amount. It was an enormous year for vehicle sales. And important for maybe the fourth quarter is the idea that it really ramped up in the second half of the year. So people may have just been saying, hey, I just got my finance bill. I'm going to be a little bit easier on buying other things. That will change as they get used to paying the monthly bill there.
Jumped ahead a little bit there.
So one of the things that we started to look forward to towards the conclusion of this panel are, from all of this data, what are things that you can take away, go back to your businesses and know for 2016, or hopefully do in 2016 to see some success? And one of the biggest things that our team has been talking about over the past year is really listening to your consumer and listening to your guest and your competitors' guests, and knowing exactly what they're saying about their experiences in your units. And we don't just mean what are their demographics, or where do they live, or how can we send them another email. We mean what feedback are they giving you in your stores about the experience. Forbes actually named 2016 the year of the consumer. So TDn2K isn't the only one thinking about this. And it's a trend that we really expect to continue to grow over the next year. Another thing that we've really been focused on and that we think is essential going forward into 2016 is really trying to understand which metrics correlate with sales and traffic for your brand and for the industry. I'm highly impressed by the work of Bob and Victor, but I'm sure, like many of you, also at times overwhelmed by the amount of data that we can look at and the amount of data that we see and have. And understanding which data points matter for restaurants is something that we try to do all day, every day, and hopefully help you understand which data points matter for your brand so that you can make smarter decisions about what you're tracking and not be quite as overwhelmed by the amount of data that is available to a restaurant today. I think the third thing that I wanted to leave you with, I guess, is understanding the differences between your top performing units and your bottom performing units. It's so easy to fall into the trap of the average, but in many cases of the brands that we work with, there are units where there's something really magical going on, and it's really easy just to say, they're doing good, let them be, and not understand what's happening there. Is it something amazing with the people? Is it something different happening in that unit? And oftentimes when you look at that bigger picture of data, you can understand what that is. What is that magic secret sauce? What is your guest telling you about the unit? What is your staff telling you about the unit? And the same thing with bottom performing units, really listening and trying to understand what exactly is happening there.
The last point, developing resources, is really closely tied to what Kathleen said about understanding the metrics. Our team gets to spend a lot of time on the phone and in person with many of the teams in this room. And one of the common themes we see is, boy, it would be great if everyone could develop that resource that allowed you to have a bridge between the data and the operations. It's, as Kathleen said and as Steve has talked about before, we have more data now coming in from more sources than we ever have in the past. And it's the ability of us to synthesize this, to take out what's important, to ignore what isn't, and identify those things that really are the things that need to pass through our filter in order to make a difference in the business. And it's going to be different for every brand. We can take a look at it from the industry level, and we're happy to help out whatever way we can. I would just encourage folks to work on getting that linkage, if you can, between the data and the operational piece. And I'm not really talking about big data. I'm not talking about the mega Hadoop loops and things like that. It's the common sense kind of numbers that I need to take and what things are really adding to the effectiveness of my organization, which things are leading indicators. We're happy to help with that, but I think there's a lot of resources out there for folks to get, an opportunity for folks to get better as more sources of data comes in different forms. It's structured and it's unstructured now. It's a different world than it was 5 or 10 years ago.
Yeah. I'd just like to make one quick point about the third bullet, knowing the dimensions of your top performing and bottom performing. We as businesses tend to make the biggest mistakes, not when things are bad, but when things are too good. And similarly, we tend to assume what's good is good for certain reasons and don't really understand why they're good. And I think what Kathleen's really getting at is that there's a wide variety of factors that are driving our top performers. And what, can we find out and understand, which is really the last bullet, all of those factors, so that not necessarily we're going to always turn around the underperforming ones, but that we can be able to recreate the top performing ones.
I'll just say one last thing here, and that's that I see a lot of the service profit chain in what we just talked about, in the sense of, you were mentioning earlier that low turnover is correlated to those, that customer satisfaction again correlated to sales. No real mystery here. Harder to do than it is to draw the correlations with that. Thank you very much. Appreciate it.